Welcome to The Explainer. Today, we're diving into a business structure that, honestly, seems a little too good to be true, the Limited Liability Partnership, or LLP. For a lot of entrepreneurs and professionals out there, setting up an LLP feels like unlocking a legal superpower. You get to protect your personal assets while running a collaborative business. But as we're going to see today, that superpower comes with some hidden tax kryptonite. If you're not careful, the very structure designed to protect you could end up totally trapping your hard-earned tax deductions.
Okay, let's quickly run through our roadmap for today. We'll be covering 1, the partnership landscape, 2, what is an LLP, 3, the tax transparency rule, 4, the deduction restriction, 5, clawbacks and deemed income, and finally 6, the math in action. Section 1, the partnership landscape, choosing your structure. So when business owners decide to team up, they usually have a few different entity choices. At one end of the spectrum, you've got the traditional general partnership, or GP. It's super simple to set up, but it comes with a massive glaring risk: unlimited personal liability. If the business gets sued, your personal savings are literally on the line. Then on the other end, we have the Limited Liability Partnership, the LLP. This one offers that highly coveted limited liability status. It's often viewed as the best of both worlds, right? Because it gives you the flexibility of a partnership, but with the heavy-duty protective shield of a corporation. Section 2. What is an LLP? The super entity.
Under the LLP Act, an LLP is legally recognized as a body corporate. Now, this is a huge distinction from a regular general partnership. What it means is that the LLP is a completely separate legal person from you, the owner. Because of this separation, it enjoys a really cool legal feature called perpetual succession. Basically, even if a partner leaves, retires, or passes away, the business entity itself just survives seamlessly. The existence, the rights, the liabilities of the LLP, they all just continue uninterrupted.
Now, there is a very specific and honestly crucial nuance to this limited liability shield. The general rule is that partners are not personally liable for business obligations solely just by being a partner. But there is a catch. You can never escape liability for your own specific wrongful acts or omissions. If you mess up directly, you are on the hook, and the LLP is liable right alongside you. But what about the innocent partners who had absolutely nothing to do with that wrongful act? Well, their liability is strictly limited to whatever capital they actually contributed to the LLP. Their personal houses, their private bank accounts, those remain completely safe. And that brings us to a really fascinating question. If an LLP is a body corporate, a completely separate legal entity that shields its owners, how on earth do the tax authorities treat it? Like, does it pay corporate tax? Let's find out. Section 3, the tax transparency rule, the paradox. Okay, so here is the massive plot twist. Despite being a corporate body legally, tax authorities treat the LLP completely differently. For tax purposes, an LLP is treated exactly like a general partnership. It is a tax-transparent entity. This means the LLP itself pays zero tax, none. Instead, the profits and losses flow right through the entity and are taxed directly at each individual partner's level. So the business is a literal shield for liability, but it's completely invisible to the taxman. Section 4, the deduction restriction, the kryptonite. To really wrap our heads around this tax restriction, we first have to define what's known as contributed capital. I want you to picture a rigid bucket. The size of this bucket is strictly determined by the capital you've actually put into the LLP, so cash or assets, but absolutely excluding loans, that you haven't taken back out yet. You also get to add in any past business profits that you haven't withdrawn. This bucket right here is your contributed capital, and its exact size dictates exactly how much tax benefit you are legally allowed to claim. Next, we have to look at what actually goes into that bucket, which the tax code formally calls a relevant deduction. This includes a partner's allowable share of capital allowances, industrial building allowances, and overall trade losses. Now, normally in a standard general partnership, you could just use all of these losses to offset your other sources of personal income, which drastically lowers your overall tax bill. But here is the absolute trap for LLPs, the absolute restriction. Your cumulative relevant deductions literally cannot exceed your contributed capital as at the end of the basis period for that year of assessment. Period. If your bucket is only $10,000 big, you can only claim $10,000 worth of tax deductions against your other income. Anything beyond that just spills over and is entirely restricted. It gets totally trapped inside the LLP and can only be carried forward to offset future income from that specific LLP. You cannot use it to lower the tax on your day job or your other investments. No way. Section 5.
clawbacks, and deemed income.
Now, let's say you've claimed your maximum deductions perfectly legally based on your capital. Awesome. But the next year, you decide to draw some of that capital out, which basically shrinks your contributed capital bucket. Well, this triggers a highly complex mechanism known as the Section 10(1) G clawback, which I know sounds exactly as scary as it is. Because your past relevant deductions now suddenly exceed your new, smaller capital limit, the tax authority automatically recalculates the whole thing. That excess amount you previously claimed is suddenly deemed to be chargeable income in the current year, meaning you actually have to pay tax on it. Concurrently, an equal amount is deemed as your share of the LLP's loss, which you can carry forward. It essentially resets your tax position, but it can create a really unexpected, nasty tax bill in the very year you just withdrew your capital.
Thankfully, there is a golden exception to this super strict clawback rule. If you are formally exiting the LLP, or if the LLP is entirely dissolving, the clawback is generally not triggered. And this provides a really vital piece of relief for partners who are truly closing up shop rather than just pulling out operating funds. Section 6. The Math in Action. Partner A.
All right, let's put some real numbers to this and meet Partner A. As of December 31st, 2021, and continuing right into 2022, Partner A has a steady contributed capital in their LLP of $25,000. So this $25,000 is our absolute unmoving cap. That bucket can hold no more than this amount.
Let's walk through their tax journey. For the year ended 2021, which corresponds to year of assessment 2022, Partner A has $18,000 in capital allowances and $3,000 in trade losses from the LLP. That is $21,000 total. Since their cap is $25,000, they safely claim that full $21,000 as a relevant deduction against their $25,000 of other income. It works out perfectly, lowering their assessable income. But we have to look closely at what happens the very next year, ending in 2022. Now they have another $11,000 in capital allowances and $8,000 in trade losses. That is $19,000 of new potential deductions.
And this is where we see the trap perfectly illustrated. In that second year, year of assessment 2023, Partner A is severely restricted. Remember, the restriction is cumulative. They already used $21,000 of their $25,000 bucket in the first year. That means they only have exactly $4,000 of space left. Out of the $19,000 in new losses and allowances, they can only deduct $4,000. That remaining $15,000 gets totally trapped as unabsorbed allowances and losses. It gets carried forward into the future and is completely useless for offsetting their $15,000 of other personal income that year. Their personal liability was protected, sure, but their tax efficiency just took a massive hit. To pull this all together into an ultimate partnership cheat sheet, think about it like this. The traditional general partnership offers unlimited liability, but absolutely zero restrictions on relevant deductions. A limited partnership mixes these rules depending on whether you're a general or limited partner. But sitting right there in the middle is our LLP. You get limited liability for everyone. Active management is totally allowed, but you are absolutely shackled by the relevant deduction restriction we just went through. Which leaves us with the ultimate question for any business owner. Is the protective shield of an LLP actually worth navigating these strict, complex limits on your tax deductions? It's a real balancing act between legal safety and tax efficiency. And as we've explored today, understanding exactly how your contributed capital dictates your tax fate is literally the only way to make the right call. Thanks for joining me on this deep dive into the LLP trap.